There's a community in America that most people drive past without ever truly understanding. No credit cards, no debt, no bank loans for cars or vacations. And yet many of these families are quietly wealthier than their English neighbors. That's what they call the rest of us, by the way. English. I'm talking about the Amish and Mennonite communities scattered across Pennsylvania, Ohio, and the Midwest. While most Americans are drowning in credit card debt, car payments, and mortgages that stretch on for 30 years, these communities have quietly built a completely different relationship with money, one most of us have never even considered. Today, I'm going to walk you through the money rules that guide their way of life. Rules that have nothing to do with modern banking, modern investing, or anything you'll find in a typical finance video. But stay until the end, because rule number 6 is the one that explains why entire Amish communities almost never go bankrupt, even during recessions that crush everyone else. Rule number 1, if you can't pay cash, you don't buy it. This isn't a suggestion. In most Amish communities, it's simply the way things are done. Homes, land, farm equipment, even large purchases. The goal is always to pay in full, up front, with money that's already been earned. Debt in this worldview isn't just a financial risk. It's viewed as a spiritual burden, a promise made to the future that you might not be able to keep. Compare that to the average American household, which often carries thousands of dollars in revolving credit card debt, paying interest rates that can climb above 20% a year. The Amish approach means things sometimes take longer to acquire. A family might save for years before building a barn or buying land, but when it's finally purchased, it's owned outright, completely, with no bank holding a claim over it. Rule number 2, the community is the safety net, not insurance companies. Most Amish communities don't purchase traditional health or property insurance. Instead, when a family faces a medical emergency or their barn burns down, the entire community steps in. This might mean a barn raising, where dozens of neighbors show up in a single day to rebuild a structure that would take one family months to construct alone. It might mean a benefit auction, where the community sells donated goods, quilts, and livestock to cover someone's medical bills. This system works because of something modern society has quietly lost: deep, reliable, long-term relationships with the people around you. When you know your neighbors will show up for you, you don't need to pay a company every month just in case something goes wrong. There's also a financial detail that's easy to overlook. Insurance companies exist to make a profit, which means, on average, policyholders pay in more than they receive back over time. A community-based system, run purely on mutual obligation rather than profit, tends to redirect far more of that money directly to the people who actually need it. Rule number 3, work is not separate from life. In Amish culture, there's no real concept of clocking out at 5 and being off the clock. Work, family, faith, and community are woven together into a single rhythm of daily life. Children grow up working alongside their parents from a young age, not out of necessity alone, but because work itself is considered valuable, meaningful, and connected to purpose. This might sound demanding, but it removes something that quietly drains many modern households: the psychological exhaustion of separating work-life from real life, as if they're two competing forces pulling against each other. When work and life aren't in conflict, the constant need to spend money escaping from work, vacations, entertainment, expensive hobbies naturally decreases as well. Rule number 4, buy quality, buy once. Amish craftsmanship is famous for a reason. Furniture, tools, and equipment are often built to last for decades, sometimes even generations. Instead of buying the cheapest available option and replacing it repeatedly, the mindset is to invest in something well made from the start, even if the upfront cost is higher. Over time, this approach almost always costs less. A well-built wooden table passed down through 3 generations costs far less per year of use than a cheap one replaced every 5 years. This principle extends to nearly everything: clothing, tools, even farm equipment. Buy it right, buy it once, and it will likely outlive the person who bought it. Rule number 5, children are raised to be producers, not just consumers. From a very young age, Amish children are taught practical skills: farming, woodworking, sewing, cooking, animal care. By their teenage years, many are already contributing meaningfully to the household's income or self-sufficiency. Compare this to the average American household, where children are primarily raised as consumers from birth: toys, technology, entertainment, and eventually expensive college experiences funded largely by debt. This isn't a judgment on modern parenting. It's simply a different starting philosophy. When children grow up understanding how to produce value rather than only how to consume it, their entire relationship with money as adults tends to look completely different. And now, the rule I mentioned at the very beginning. Rule number 6, Amish and Mennonite communities almost universally avoid what's called lifestyle inflation, the natural tendency to spend more as you earn more. In mainstream American culture, when someone gets a raise or their business grows, spending habits often expand right alongside it. Bigger house, newer car, more expensive vacations. The lifestyle grows to match the income, and sometimes even exceeds it. In Amish communities, this pattern is deliberately, almost aggressively, resisted. Homes remain modest regardless of how successful a family's farm or business becomes. Clothing stays simple. Vehicles, where permitted, stay basic and practical. This means that as income grows, the gap between what's earned and what's spent actually widens widens instead of shrinking. And that widening gap is where real, lasting wealth quietly accumulates. This is precisely why entire Amish communities have historically weathered recessions, farm crises, and economic downturns far better than the average American family. Their spending was never built on the assumption that income would keep climbing forever. It's a simple idea, but it might be the single biggest reason their communities build lasting financial stability, generation after generation, without ever touching a stock portfolio or a retirement account. Think about how differently this plays out over a lifetime. Two families might earn the exact same income over 30 years. One spends a little more each time their income rises. The other keeps their lifestyle essentially frozen. By the end of those 30 years, the gap between them isn't small. It's often the difference between financial stress and genuine, lasting security. Rule number 7. Debt for a business is different from debt for a lifestyle. While personal debt is heavily discouraged, some Amish business owners, particularly in construction, furniture making, or farming, do occasionally take on limited debt for tools or equipment that will directly generate income. The distinction is important. Debt taken on to produce more value is viewed very differently from debt taken on to fund a lifestyle that looks impressive but produces nothing in return. This mirrors a principle that even sophisticated investors follow. The difference between good debt used to build an asset and bad debt used to fund consumption that disappears the moment it's purchased. Rule number 8. Retirement doesn't look the way you'd expect. There's no widespread reliance on 401k accounts, pensions, or government retirement systems within Amish communities. Instead, older generations are typically cared for directly by their extended families. A grandparent doesn't retire to a facility. They often remain on the family property, contributing what they can and being supported in return by their children and grandchildren. This removes an enormous financial burden that many American families quietly struggle with: the need to independently save hundreds of thousands of dollars for a retirement that might last 20 or 30 years. When the family itself functions as the retirement plan, the entire financial equation of a lifetime changes dramatically. Rule number 9. Simplicity is a deliberate financial strategy, not just a religious preference. It's easy to assume Amish simplicity is purely about faith and tradition, and religion absolutely plays a central role. But simplicity also functions as an extremely effective, almost accidental financial strategy. Fewer possessions means fewer things to maintain, repair, insure, and eventually replace. A simpler home means lower utility costs, lower property taxes, and less money tied up in something that doesn't generate income. Every dollar not spent maintaining an unnecessarily complicated lifestyle is a dollar that can instead be saved, invested in land, or passed down to the next generation. And finally, rule number 10. Money is a tool for the community, not just the individual. Perhaps the deepest difference between Amish financial philosophy and mainstream American thinking is this: wealth isn't primarily viewed as a personal achievement to display. It's viewed as a resource meant to strengthen the family and the broader community. This shapes everything from how businesses are run to how profits are used. Success isn't measured mainly by what one person accumulates, but by how stable and self-sufficient the entire community remains, generation after generation. So there you have it. 10 money principles from a community that most Americans drive past every day without a second thought. No credit cards, no debt for lifestyle. A community-based safety net instead of insurance companies. Deliberate resistance to lifestyle inflation, and a definition of wealth that extends far beyond any single bank account. You don't need to give up modern technology or join an Amish community to apply some of these principles. Even borrowing 2 or 3 of these ideas, avoiding lifestyle inflation, buying quality over quantity, or building a stronger financial safety net with the people around you, could meaningfully change your financial future. In a culture that constantly pushes us to spend more, borrow more, and want more, there's something quietly powerful about a community that's been doing the opposite for over 300 years and building real, lasting wealth in the process. If you found this video valuable, hit like and subscribe for more videos exploring the money habits of communities most people never think to study.